Now we're going to be calculating depreciation and accumulated depreciation. Remember, depreciation is simply the cost of using an asset. You start depreciating an asset once it's in conditions ready for it to be used. Remember, an asset generates income. Actually, asset is used to generate income. We use it in the business to generate income. Basically, as much as we earn income, at the same time we need to recognize the cost of using that asset. So basically, in this case, we're just using the matching principle. All right, income must be matched with all the expenses. As we use the asset, we take parts of that asset, we change it from an asset to being an expense that will be recorded in the income statement. Okay, please note that once you have started depreciating an asset, you will depreciate that asset up to a date when you sell it, or up to when it is just useless. You just dispose it. Okay, it no longer generates income for the business. It's the earlier of the two. So basically, in this case, you need to actually draw your timeline. The beginning of the financial year is the 1st of July 2011. The end of the financial year will be the 30th of June 2012, and this asset was used until the 30th of March. Okay, please note that March is simply 3 months before the end of the financial year. Okay, now depreciation and accumulated depreciation. You will start with accumulated depreciation of all assets at the beginning of the financial year, and you will also start with accumulated depreciation of the asset that has been sold. And when you take accumulated depreciation of all assets that you have at the beginning of the year and minus accumulated depreciation of the assets sold at the beginning of the year, you will get accumulated depreciation of the remaining assets at the beginning of the year. Basically, this 294,800 is the balance of all vehicles at the beginning of the year. It's basically the balance of accumulated depreciation of all vehicles at the beginning of the year, and this is the accumulated depreciation of the assets sold at the beginning of the year, and you'll be left with the balance of all vehicles not sold. Basically, this is the accumulated depreciation balance of all vehicles that were not sold. Now, to calculate depreciation of the asset that was sold in the current financial year, you're going to start with the cost price of the asset, which is 165, and then write the accumulated depreciation of the asset that was sold at the beginning of the year, which I did give to you guys, which is 66,000 rand. Now take the 165,000 rand minus the 66,000 rand. You will get the carrying value at the beginning of the year, and the carrying value at the beginning of the year will be 99,000 rand. Now it's very important for you to calculate carrying value at the beginning of the year, as it helps you limit the depreciation amount that you need to recognize on this asset. Please note that in any financial year, when you recognize depreciation, it shall not exceed the carrying value of that asset at the beginning of the year. As a matter of fact, you limit it if it's more than the carrying value of the asset that was sold, that specific asset. As a matter of fact, you will simply limit it to the carrying value minus 1. Okay, in this case, for you to calculate the current depreciation, you will simply current year depreciation of the asset sold. You will simply take the carrying value of the asset, which is 99,000, but you'll have to apportion it. This is because we didn't use this asset for the entire year. We only used it for 9 months. Okay, we only used it for 9 months. Basically, this asset was used from the beginning of the financial year up to the end of March. Okay, so basically it was actually used up to there, which is the 30th of March. All right, and that will be 9 months. Count. Don't be afraid to actually use your fingers all the time. I will start with July, August, September, October, November, December, January, February, March. I will count March because it was used for the entire month of March. It was used up to the 30th of March. So basically, I'll have to depreciate it from the 1st of July up to the 30th of March. Okay, now the current year depreciation on this asset will simply be that 99,000 rand multiplied by 20%, multiplied by 9 over 12, which will give you 14,815, and that is the depreciation for 9 months. Please note that the depreciation on this asset at the beginning, accumulated depreciation of this asset at the beginning of the year was 66,000. Okay, accumulated depreciation of the asset that was sold at the beginning of the year was 66,000 rand. So basically, this 66,000 rand is the balance here. Now we need the balance over there, but please note that it will be calculated at the end of the financial year. Okay, in this case, you're gonna take 66,000 rand that you have at the beginning of the year, you add current year depreciation, which was for 9 months, and it will give you accumulated depreciation of this asset, which will be 80,850. This is the accumulated depreciation of the asset that was sold on the 30th of March 2012. This is the date when the asset was actually sold. Remember, accumulated depreciation is the sum of all depreciation of an asset from when it was purchased up to a day when it is sold. Okay, now I need you to understand that this 14,850, which is the current year depreciation, will be shown on the credit side of your accumulated depreciation account. Remember, accumulated depreciation account, it's simply an account where we record depreciation, and depreciation reduces the value of your asset. That is why it increases on the credit side. It simply is a valuation allowance. It helps us value the asset correctly, because the value of the asset decreases as we use it, except for a couple of assets. I did specify to you guys which assets will actually increase in value, and at this moment, please remember that we are simply measuring our assets using the historical cost. When you go to varsity, there's going to be something else we call the revaluation model, and you will learn that later on when you do IS 16. But for now, focus on the fact that assets will always be measured at historical cost. That is for now, for the grade 11 up to 12 syllabus. Okay, now in this case, there's 14,850 will be recorded on the credit side of your accumulated depreciation, and the 850 will be recorded on the debit side of your accumulated depreciation. But remember, this relates to the depreciation of the asset that has been sold. So when that asset is sold, you also get rid of the accumulated depreciation that relates to that asset. That is why that 80,850 will be recorded on the debit side of your accumulated depreciation. Okay, now in your accumulated depreciation account, you will have that 80,000 rand on the debit side. On the other hand, we still have assets that were not sold. In this case, the assets that were not sold, we still use the same formula where you have accumulated depreciation at the beginning of the year, you minus accumulated depreciation of the assets sold at the beginning of the year. You are left with accumulated depreciation of the remaining assets which were not sold. So we're trying to calculate the depreciation, the current year depreciation of the assets that were not sold. Okay, now you're gonna start with the cost of the remaining asset, which is 649,000. Please check the previous video as to how I got that 649,000 rand. Accumulated depreciation of the remaining assets at the beginning of the year will be the one that we just calculated now, which is 228,800. Minus that, you will get carrying value of the remaining assets at the beginning of the year, which is 420,200. Take that 420,200 and multiply it by 20%, and you multiply it by 12 over 12. That is because we have used the remaining assets for 12 months, and that will give you 84,040. Please note that accumulated depreciation of the remaining assets at the beginning of the year is 228,800. Accumulated depreciation at the end of the financial year will not be the same as that, because it has to be increased by the current year depreciation, which is 84,040. Hence, accumulated depreciation of the remaining assets. I'm just going to show it quickly. Now, in this case, the depreciation of the remaining assets will be recorded on the credit side of your accumulated depreciation, because accumulated depreciation will always increase on the credit side by the depreciation amount. Okay, now at the end of the financial year, we're going to have accumulated depreciation of 312,840, which is this 228,800 plus the 84,040. So this plus that will give you 312,840. Okay, which is the accumulated depreciation of the remaining vehicles. Accumulated depreciation balance at the beginning of the year will be 294,800. Depreciation of the assets sold in the current year was 14,840, and the depreciation of the remaining assets was 84,040. We need to get rid of the depreciation, accumulated depreciation of the asset that was sold, and in this case the accumulated depreciation of the asset that was sold is 80,850. I did show that in the timeline, and then you're gonna be left with the carrying value of the remaining assets, which is 312,840. You can still check the timeline. Remember, this is just accumulated depreciation of the assets that are still remaining, that are still in the business, that we haven't yet sold, and you will have your carrying value. This is only the carrying value, this is the balance carried down of the accumulated depreciation of the remaining assets, which is 312,840. So this 312,840 is the accumulated depreciation of the remaining assets. Remember, the cost of the remaining assets is 649,000. Please check the previous slides, and this is just me explaining what is going on. Okay, stay in touch, more to follow.